I don't think the Fed has anything to do with what we call inflation. It's oil prices and used car prices that were triggered by the base effects of shutting an economy down, then turning it back on. And look, CPI perfectly correlated 16 months after M2 growth. M2 growth went negative for the first time in, I think, 96 years. Let that one sink in. It's been 96 years of constant money printing since the Fed was created to diminish the value of the currency, to steal wealth from the masses and give it to the people at the top, which, right, income and wealth inequality is where it is. So mission accomplished by the Fed.
The turmoil in the economy and markets in 2022 may serve as a tiny prelude to what the U.S. stock market and economy would face in the ensuing 10 years. The stability and expansion of the U.S. economy may not be most at risk from inflation in the years to come, according to a number of eminent investors and analysts. The world's largest economy would see weak or no economic growth for at least a decade, according to the most recent edition of the popular hedge fund on the margin weekly roundup with Blockworks Macro. Mark Yusko joined the group of other elite investors who made this prediction. In the podcast, Yusko said that the labor market and the phony economic growth seen in the fourth quarter of 2022 are the only factors preventing a recession. Before we listen to Mark Yusko's interview, just take a moment to like the video, subscribe to the channel, and enable post alerts for more content like this.
The challenge now is, again, I don't know, all of this is literally nonsense in that there is no pricing power for employees. How many announcements of 10,000 workers being laid off have you heard in the past month? Every single day, another company is laying people off. Our company, for the first time in 20 years, we had to let some people go. It was just never, we never got to that point before. This has been, and this idea that, unemployment rate is so low. Well, no, it's not. It's because you're fudging the numbers. Again, the massive engineering, right, by taking people out of the labor force, making the labor force seem smaller, so the percentage of unemployed, those people are still working. But just because they turn 65 doesn't make them out of the work. That's the way they do it. And the birth-death ratio nonsense. So I hear the narrative that people have crafted, and I hear the torturing of the data, right? If you torture the data long enough, it will confess. The torturing of the data continues, but you go around and you look at economic activity, which is the true measure of whether wages are good or not good, or economic activity, it's not so good. In fact, some of it is downright abysmal, like plumbing levels we haven't seen since global financial crisis or the Great Recession or the period, the tech wreck. Look, from 1968 to 1982, the economy went precisely nowhere. We had multiple recessions, multiple recoveries, and quote unquote these soft landings. Because I guess if you fall from a really low level, it's softer than if you fall from a really high level. So the fact is you never took off, you didn't crash. So I guess that's one way to look at it. But from 68 to 82, stock market was precisely 1,000 points. The Dow Jones Industrial Average was 1,000 points for 14 years. And yes, it went up and went down, and there were big drawdowns and big recoveries. No, there's another bull market. Dead flat for 14 years. So that's where I think we probably are. I think we're going to have a lost couple decades of basically no economic growth, kind of like Japan's had for the last 3 decades. Stock market probably does this, right? I made the bet with Kevin O'Leary on CNBC 4 years ago that Amazon would be dead money for a decade, and so far I'm winning. And I don't. Again, I'm not gloating in the fact it's not that Amazon's not a good company; it's a great company, but they just reported the largest loss in their history. Apple was bad, Amazon was bad. I can't remember the other two, but all 4 of them bad. And on top of that, that's on top of Microsoft was bad, Netflix was bad, even Meta was bad, right? They missed on revenue. The revenue growth is turning down. Apple's, which just went negative. So those are not growth companies. Look, there's no question Q4, fourth quarter, massive government spending, big inventory build. And Powell did say, right, don't expect those two things to continue, right? So he was kind of warning that Q1 GDP is going to be not so great. But if you look at Q4, 75% of the growth, it wasn't really growth, was this draining of the TGA, government spending, and building up inventories. Now look, we did talk about this a few weeks ago, saying that the amount of tax loss selling that occurred in 2022 did set the stage for the potential for this January effect. Now I didn't think it was going to be this crazy, where you had stocks going up 30% every day, and companies like Bed Bath and Beyond, I mean, bankrupt, like liquidating, gonna go away, and people are still punting in that stock. So good for them. Musical chairs, it's not a game I like to play. But here's the thing that I just don't understand is the Fed is not adding liquidity. They're just not, right? They're simply not. The ECB, not. See, the ECB is now in the hot seat. Ms. Christina, she's got a problem. She is now the one that has to raise. She's 200 basis points behind everybody else. That's going to be a tough one for Europe. Now, the European banks love it, and the European banks are going, bananas. But rest of Europe isn't going to like that very much, particularly the exporters, because it's going to strengthen the euro, and dollars continue to fall. Euro is going to strengthen. The yen is the wild card. I mean, Kuroda-san unleashing this Kuroda tsunami, that should actually weaken the yen pretty badly, which maybe the dollar stays flattish. But the euro probably going to rise a lot, and it's going to be tough to sell, Volkswagens and Audis if your currency's strengthening. So I think Europe's going to struggle from an economic growth perspective. In fact, I think Germany just went negative in Q4, like 0.2 or something like that. Economically, I get why Jay Powell is saying, don't count on the government spending to continue, because we're almost out of money, and they're certainly not going to increase taxes, because that's not a popular platform to run on. I still come back to PMIs are rolling over, industrial production is rolling over, new orders component of PMIs are rolling over. I don't see any catalyst for a strong recovery. And if the definition of soft landing is the Chuck Yeager, right? Any crash you can walk away from is a good landing. Okay, well, we're not going to crash, but I don't see us getting back in the sky anytime soon.
Yusko also stated during the podcast that he would start to shift his economic outlook from gloomy to bullish if there were improvements in the Purchasing Managers' Index, retail sales, industrial production, or first quarter GDP. However, that is yet to be seen. Even a steady upward trend in any of these measures could point to a significant improvement of the economy. Yusko's assessment of the stock market is in line with one made previously by Gareth Soloway, who thinks that investors should diversify into other assets, including Bitcoin and other leading cryptocurrencies, because the US stock markets may have a difficult year. What do you think about these forecasts for the American economy and stock markets? How do you believe the future price of cryptocurrencies would be affected if stock prices continued to fall over time? Please share your thoughts in the section below. Also, be sure to watch our other videos, subscribe to the channel, and like this one.